Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Stocks closing mixed Wednesday. Investors saw Oracle surge, and investors are eyeing inflation data and any moves, of course, around the Federal Reserve. And Klarna makes its official Wall Street debut, IPOing at the New York Stock Exchange. We're speaking with the company's CEO live on his big day. And from traditional trading on Wall Street to Robinhood success, we're talking to Hood's chief brokerage officer as the retail trading platform holds an important summit. Well, Klarna making its market debut on Wall Street and the stock jumping on the day. Join me now from the floor of the New York Stock Exchange. We've got Sebastian Siemiatkowski, Klarna CEO. Sebastian, it is great to see you. Congrats, Sebastian, on the big day. Walk us through, Sebastian, what this day means for you, Sebastian, for the company, and why go public now? What were the variables, the factors in that decision?
Look, it's been obviously, due to the very troubling news just recently on Charlie Kirk, I'm a little bit not in the celebratory spirit I was previously, but it's been obviously a fantastic day. I'm very happy to see that, we came here and for our employees and for the long believers that have been investors in the company for 2 decades, seems to be what was a very successful day with good trade and well-receptive market has received us very well. So we're very happy.
Charlie, Sebastian, I want to acknowledge also, to your point, Charlie Kirk, and obviously our thoughts and prayers are with him and his family at this time. For you, Sebastian, you think about this market opportunity. I'm curious how you think about it, how big the opportunity is, and how fast it could be growing.
Sure. Look, Klarna is now at 111 million users, which is pretty amazing. We've been growing, and our main focus for the last decades have really been how do we reach as big of an audience, how do we get as many users as possible, and then more recently, we've been starting to focus on how do we sell more services and increase the revenue per user, right? And so you look at us compared to some of our competitors, there are 1/3, a firm is I think 30 or 25 in total. We have Revolut in Europe that is 40, 50 million users. Klarna at 111 million users, but our revenue per customer is lower, and that's where the big opportunity is. That's why we're very, very happy to see, for example, we launched a card just 6 weeks ago here in the US. We now have 700,000 users, 5 million people on the waiting list. So we see a lot of opportunity on how we can bring more financial services once we have established that relationship with them and they use us for a buy now, pay later at Sephora or Macy's or Walmart or eBay or all the merchants that offer Klarna today.
Sebastian, for investors who are listening right now, why should they put money to work, Sebastian, in Klarna, rather than your rival Affirm, which analysts are quick to point out, Sebastian? Affirm, they say it's growing faster and it's more profitable.
Well, I think that the truth is that if first and foremost, I haven't sold a single share today. I'm a big believer in the company. I'm a big believer in the opportunity. Klarna is a very different business. Our focus has really been about growing in the pay in force space on the everyday transactions. You've seen us sign Uber, you've seen us sign DoorDash. Our experience is that the most critical thing is to build relationship with a lot of customers. We have more customers than Affirm here in the US as an example, and more globally. So first we build a relationship. We know this from Europe. We build that relationship. We become an everyday spending partner for the users. And then we can start upselling, whether that's fair financing, longer term financing loans like Affirm does, or whether it's other services like subscriptions and cards and other offerings that we're doing in Europe. And what we see then is that people really love those. If you look at some of our card users, our revenue per user there is 5 to 10x higher than the standard user. So that's a huge opportunity here. But our main focus has been growing number of users, and now we're coming into the monetization.
One question I hear asked, Sebastian, and I'm curious to learn more about this, and to make sure I'm understanding correctly, is that you all go to Pagaya to help underwrite long-term loans in the US. I'm curious why you do that, why you outsource that, Sebastian, because it's pointed out that Affirm, they don't do that. They actually own the underwriting IP.
Yeah, that's not entirely correct. So what happens is that Klarna is a bank. We're a fully regulated bank, different than Affirm, and we put most of our loans on our own balance sheet. We underwrite them ourselves. That's also a very big difference. And if you look at it, is that like because of that, we recognize the provisioning of our loans directly, while the revenue comes over a longer period of time. A firm is selling off about 50% of it to partners. Pagaya is a great partner, a small partner. A small proportion of our loans in the US are underwritten by them and given them, but the majority of all the loans are underwritten by ourselves. 97% of our loans are 0% interest bearing. And we have been doing underwriting for fair financing and for longer term tickets for 2 decades. So it's not entirely correct. We do most of it ourselves, most is on our own balance sheet. But that also means that as we grow now quickly the fair financing product, as we grow, for example, one Walmart and started working with Walmart away from a firm, this means that we will see a growing amount of those loans, and the revenue will come over the coming quarters because it's more profitable. Our funding with deposits is just much cheaper than selling it off wholesale like a firm does.
So just so I understand, Sebastian, so when you're assessing the risks of making a loan to Josh, you're doing that. You're not outsourcing that.
Nope.
Got it. Let me ask you this. We talk a lot about AI on this show, Sebastian. I just want to get a better sense of how you're leveraging that for your business now and ahead.
Sure. I mean, there's been a lot of writings about that. We were very early to apply AI in our customer service that saved us about $40 million and increased our quality. I would say the most important thing, we took our average response time from 12 minutes down to 2 minutes, so customers were much happier as AI was much more responsive, faster. So that's been great. We've also had significant implications on our OPEX. We haven't been laying off people, but we haven't been recruiting for 2 years, pretty much, net. So we've been shrinking on average about 20% on an annual. We recruit a little bit, but we recruit much less than people leave, meaning that we've gone from 7,400 employees to just 3,000 currently, or taking the revenue per employee from 450K to over $1 million. And we expect that to continue. There's still tremendous opportunity to use AI to make us more efficient, but we don't want it to just be about efficiency. It's been a big focus of ours, but now what we're very, very, very keen and excited about is to take those learnings when we've been using AI as ourselves, as guinea pigs, as employees, to bring those services to consumers and merchants alike and see how we can create the next generation of retail banking services, the next generation of our app that is superior to what we have done historically as we integrate AI into that technology. So that's a huge opportunity and something we're very excited about.
Let me ask you a bigger picture question, Sebastian. Investors are betting the Fed's going to cut at this next meeting. That's good for Klarna, right? Lower funding costs. On the other hand, we are seeing signs here of a weaker labor market, and I'm curious what you think that could mean for Klarna, what that could mean for loan demand going forward.
So this is actually one of the reasons we've been focused so much on the short-term lending compared to like a firm that's doing slightly longer-term lending. The key thing for us is that the average duration on our balance sheet, people pay us back between 40 to 60 days, right? That means that when I've been with this company through a few recessions, when a recession comes, what you can do is you can change your underwriting, change the way you take decisions, and in just slightly more than a month, more than half of your balance sheet is underwritten by the new standards. This gives a company like us an immense flexibility and agility that normal banks don't have. A large bank, they're sitting with credit card loan portfolios. It may take them 3 years to heal and change, and make sure that the new underwriting models are, taking into consideration and heal the balance sheet. So it's very, very different. And that is actually a huge strength of the model that we apply. And we've seen that in Europe and now in the US as well. During COVID, during different opportunities, when we changed the underwriting model, you have a very immediate effect, which is very, very different than the traditional banks.
We're always looking for lines of sight on the American consumer. Sebastian, you have a line of sight there. What do you see in terms of spending and credit quality? How healthy, how resilient does the American consumer look?
Well, look, I think among our customers, we're actually seeing that they're spending, continue to spend. There isn't that much of any signs of a recession in their spending habits. I think it's also, our group is a very, is a group that really, what we call self-aware avoiders. These are customers that earn slightly a little bit more than low-income households. They're very conscious about their economy. They're not into credit cards. They think about it as the product of the devil, with with a lot of interest and revolving. They like this fact that it's a budgeting tool. They think about buy now, pay later as a budgeting tool. It's a fixed installment, 0% interest. And these people are also slightly more, thoughtful about their spending. But so far what we've seen is that they continue to spend.
Sebastian, great to see you today. Congrats again on the big day.
Thank you so much.
Stick around. Much more Ask for a Trend. That's still to come. Robinhood hosting its annual Hood Summit in Las Vegas and unveiling new tools within its app. Stock has been on a historic run here. It's up more than 200% so far this year. Joining us now, we've got Steve Quirk, Robinhood Chief Brokerage Officer. Steve, it is always great to see you, my friend. So you introduced some new products here, including this new social network, Steve. Walk us through that, Steve. Who is this network for? What's it going to mean for the business?
Sure. Thanks for having me, Josh. Yeah, we're celebrating some releases here with 1,000 of our customers, and we've had about almost 13 million streams of the event last night online so far. The highlight of it is social, as you pointed out. It's really kind of designed for the whole gamut of our customer base, and when I say that, I mean for our very sophisticated and engaged investors. They like to validate trade ideas or theses with each other. And they like to be able to follow people who they respect and think have a good history. For our more novice investors who are newer to investing, and again, we're 26 million customers and half of them are new to the market and in their average age of the very early 30s, this is a source for them to get ideas about what to trade and ways to trade it strategically.
When I hear your CEO, Steve, he'll talk about kind of the ultimate goal. I think Vlad puts it like he's looking to build, I think he says the financial super app, right? Is that sort of what we're doing here with the social network, and we got the prediction markets and the trading? Is that it, Steve?
Mm-hmm. Yeah, that is, because if you think about what a super app would encompass, it's every single asset class that you can think of. So whether it's futures, crypto, equities, options, ETFs, prediction markets, there's a source of information for anything that anybody on Robinhood's ecosystem is doing. And then we give you an offering that permits you to capitalize on any idea that you see there. So if I want to follow people, if I want to get alerted, if I want to look at their trade and say I'd like to do something similar, we make it really seamless to be able to do that.
Overall, Steve, just more broadly, I'm just curious how you would characterize what you're seeing from your customers right now, what you're seeing just with overall equity volumes and options volumes.
Yeah, our equity volumes, option volumes, and deposits, because they're all kind of telling on what sentiment is. I would call them a little bit cautious right now, and what I mean by that is we've been having record options and equity volumes. We're close to record highs in terms of volumes and deposits, but we're seeing some behavior where we're the most popular names, the Mag 7, if you will. People are rotating out of some of those because they've had such good appreciation. And we kind of had a historic shift, which, for 5 years, Tesla has been the number one holding for Robinhood, and that just got surpassed by NVIDIA. So for us, that's interesting.
What about your stock, Steve? I have to ask you about this. I mean, you're up, we said 200% this year. You pull the chart back up, Steve. Mm-hmm. You're up more than 500% now over the past 12 months. What do you make of that, Steve?
What I would say is we've been working very hard. The whole team has to build out the offering, and we're expanding both in our crypto offering and in our traditional finance offering to include some wealth management instruments for customers as well, not just self-directed. And I think you're starting to see that pay dividends. That, along with the retirement offering and some of our yield products, are really attracting a lot more customers and having them bring more of their wealth into Robinhood.
And what would you say, Steve, just final question, I'm curious. I mean, listen, it's a competitive market you're in. I mean, what would be your kind of core advantages as you take on the established kind of entrenched rivals?
I think we move pretty quick, we are truly a technology firm that is in financial services. So we run a lean model, but we also can move very quickly. So when new things come, like the election contracts that we rolled out, as soon as those became permissible, 2 weeks later, we had them out the door. I don't think you're seeing that from our competitors, and I don't think you're going to see that from our competitors. And so I would say that's probably our biggest advantage.
Steve, always great to see you and to have you on the show. Thank you.
Thanks, Josh.
Stick around. Much more Ask for a Trend. That's still to come. In 2007, the housing bubble began bursting with subprime defaults spiking. By 2008, Bear Stearns, an 85-year-old Wall Street titan, saw its demise, becoming a canary in the coal mine for a global financial crisis. Trader Talk host and veteran Wall Street trader Kenny Polcari sat down with Broadridge Financial Services' Jamie Bogen on the turmoil leading up to that pivotal moment in our economy.
My first kind of memory of things really starting to crack was when Bernanke said that the subprime crisis, is grave,
right,
but largely contained.
Right. Remember that? I remember that very loud and clear.
Right. He had no idea.
Right.
He had really no idea. So I ran the equity trading operations at BSAM, but I was on all of the committees within our division.
The internal committees.
I was on the risk committee. I was on the pricing committee. So I saw everything happening kind of in real time.
Unfolding right in front of you.
Absolutely. And one thing that kind of stood out to me at the time was after Bernanke made those comments, there was a lot of rumors on the street, of course, but we had a problem getting marks for our funds. So we marked our funds once a month.
Right.
And we got marks from all of our counterparties. And the way we dealt with those is we took an average.
Right.
All of a sudden, instead of getting marks that were tight,
right,
we got marks that were at par, maybe one or two dealers, and the rest of them were at 70 cents on the dollar.
Right, so 1 second, just explain really quickly, the mark is the pricing.
Right, because these are not exchange-traded securities, so you needed to get pricing from dealers. Every month you better report to the shareholders, or not the shareholders, but the investors in the funds.
Right, what the dealers were essentially willing to pay.
Exactly.
So you have a range of prices, and you kind of decide in the middle.
We would average them, right? And they were never that broad.
Right.
They were always within a few points.
Yeah.
All of a sudden, they came in like really wide.
Right.
We also would release an early look at performance.
Right.
And then the final numbers, maybe, because it was quarterly, maybe a couple of weeks later after everything was, dotted and tied. We couldn't release them.
Right.
Because they were not correct. We had internal conversations. Did we want to stay with the same pricing model? Did we want to go to matrix pricing? We stuck to our guns. Our risk committee said, we're not changing.
Right. Had you changed, it might have raised a red flag. Why are they changing the way that they're pricing these models?
It could have. But again, the problem was that as this was happening to us, it was happening to others, unbeknownst to us. Right. So, some of our biggest competitors, Merrill Lynch, had a very large mortgage book, at the time. So this was not unknown internally. But externally, it really wasn't, right? So what caused this, right? At the end of the day, we had a shadow banking system, which came into effect after Glass-Steagall was let go, after we got rid of that. And all of those investors pulled. So not dislike went on the NYSE. We used to have a specialist model. Specialists had to make a market.
That's right.
There's no obligation.
Right.
When there's no obligation, everybody goes like this.
That's right.
Everybody
when there's
heads
no
for the
obligation,
hills.
there's no obligation.
Correct. So what happened along with that was there were rumors starting that Bear Stearns was going to have a problem. Internally, there was a very big conversation with the very senior management level on whether we were going to backstop the funds.
Right. Whether Bear Stearns was going to backstop the funds.
Absolutely. Whether Bear Stearns was out of their own pocket going to say, we're going to take this debt onto our balance sheet, backstop.
Right.
We didn't.
Right.
Okay? If we did, it probably would have just staved off the end. This is all in retrospect.
Yeah.
But it really didn't. The decision was made that we weren't going to backstop the funds, and that was that. Then we get into 2008, and the rumors are rampant about Bear.
They're building and they're building and they're building. Every day it was a new rumor.
Absolutely. And there was conversations also going on in all the desks. Like, I got a call from a buddy of mine who worked in London on a currency desk and said, what the hell is going on over there?
Yeah,
right? Because it was coming from overseas. And there was a lot of rumors about who the source of these were. We all lived during that time. But the way that we were financed, and most brokerage firms are financed, right, and especially on the prime brokerage side, was through short-term money, right? Commercial paper, repo, had to be rolled. Bear had one of the largest prime brokerage operations, and that was where people were kind of coming for us, okay? There was kind of an internal joke that when Jamie Dimon walked in the lobby, our stock price came up because people always thought that Jamie wanted to buy Bear. Right? This was before he had no choice but to buy Bear. Back in the day, right?
He bought Bear.
He bought Bear, and he got us
at $170.
No, he got us at a good deal. Right. So what started to happen was the whispers were going around behind the scene. Large equity clients were pulling their prime brokerage from Bear because they couldn't take the risk. They had a fiduciary obligation.
They had a responsibility.
Right. And they were going to our competitors who probably were exacerbating the situation. We all know how that works. Okay?
Yeah.
And then one day, we couldn't roll our paper. And that was on the 14th
of March.
That was on the 14th of March. We could not roll our paper. And internally, what was happening was, behind the scenes, people were selling their stock. Prior to that. Prior to that. But right around that time in March, we were in a quiet period because we were due to announce earnings. And our earnings were supposed to be excellent. Didn't matter. Couldn't finance, didn't matter what the earnings were.
That's right.
Right?
After it collapsed and then you stayed, then we saw the ball rolling down the hill, right?
Yep.
Lehman Brothers was next, and then they drew them all in. It was Bank of America Merrill Lynch. Remember when John Thane went there and asked the questions, and 3 months later, he realized he was in trouble as well.
You needed a commercial bank to backstop to be able to have that. You couldn't do that without a bank, without being a bank. And as Goldman Sachs, Morgan Stanley, they're all banks now, right?
And so that event really led to a complete reorganization of the industry.
It did.
How it worked, how it's financed, who the players are, and how trading happens.
Absolutely. Yep.
Anyway, Jamie, let me ask you a question. Would you have changed your career? Not in a million years,
no.
And people ask me about this. I spent 40 years here. I loved every minute of it. I would not change it.
The same. I would not have changed it for 1 minute.
That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wealth. Have a great night.